Hello, hello. Is anybody here? Is anybody here? Wait for for people to join. Oh, hello, hello, Sagar. Hello, Vanessa. Hello, Alvaro. Thank you for sharing the chat that you are seeing the screen. Can you hear me well? Hello, guys. Please, if you're here and you can hear me well, please text something in the chat. I can see the post from Alvaro, from Anissa, and from Sagar. Sorry if I don't pronounce well any of your names. Sorry for that. Hello, thank you. I'm gonna test sharing the screen just to see if everything works properly. Also, you should see the beginning of the presentation. Okay, so I'm gonna go back again to see in your chat. Oh, thank you, thank you, thank you for telling me that I pronounced well. Have you seen the presentation? It is working properly? Okay, okay, thank you. Thank you, DTH Dynamics account. Okay, so we have 3 minutes left for 12 p.m. Okay, thank you. I will say this every time during the meeting, but thank you guys for this support and for attending to this masterclass, because it's absolutely a pleasure. I'm absolutely nervous because I've never talked in front of so much people, but I'm pretty sure that you will like it. Okay, I don't see here in the in this platform I'm using the number of viewers. Could someone share with us how many people is watching right now? If you see on LinkedIn or even in YouTube, because we are live on both platforms. Okay, 15 people from LinkedIn. So, okay. So let's wait for a couple of minutes. Maybe we can start at 12, 2 minutes or something. Hello, Ivan. Thank you, DCH. You can post how many people is going up and in this live session. I see that one person is seeing the live on YouTube. This data I can I can track, but not the LinkedIn one. Okay, so it's 12 p.m. We can wait for a couple of minutes more. You can follow us also, apart from YouTube and LinkedIn, you can follow us on Instagram. To any people, thank you, thank you. I think we are gonna wait just one more minute and we can start. Maybe we started a little bit early, but I prefer to commit to the time we decide for this masterclass. Hello, Jorge. I see you are watching us from YouTube. Thank you, thank you for your words. It's a pleasure to share with you guys this experience. It's the first time, at least it's working properly right now. Hello, Elena. Thank you for attending, guys. 26. Okay. Okay, so I think, guys, we can start. We are 26 people on LinkedIn and 3 people on YouTube. So let's see how it goes. If in the next couple of minutes someone else can join us. Okay, so let me share my screen. Okay, so hopefully I cannot see the chat right now, so hopefully you are seeing the presentation. Let me double check on the chat. Could someone text if you can see the presentation? Hello, Jesus. Thank you for joining. Hello, Elena. Hello, Borja. If someone can post, if you can see my presentation, I would really appreciate, and we can start. Okay, fantastic, fantastic. So let's go. Let's go. So thank you everyone for coming. This is an absolutely pleasure to try to share with you what I know about investing, one of my passions, as part of DCH Dynamics initiative. I also want to I'm really nervous because it's the first time I speak in front of so much people. So hopefully it will be fine. But I think you guys will really love this presentation and this masterclass. So thank you for everything. And I also want to thank our sponsors, which are there, Acatec, Sensing, Maxon, and RS Components, sponsors of DCH and helping us in this impressive journey. So I'm speaking and you don't know me. So who am I? I'm Jose Maria Castillo. I'm the head of business operation, DCH Dynamics. Basically, I'm in charge of looking for funding opportunities, sponsors, increase our outreach and in social media and so on and so forth. And in fact, I'm looking for a new team member to join into the team. So if you like this presentation and you want to join us, please don't hesitate to contact me. And what is DCH? I'm also working for Airbus as a service project manager. But what is DCH Dynamics? DCH Dynamics is a research group which is a pioneer in the development of transformable spacecraft. And you maybe are wondering, and what is the relationship between developing a new technology for space and investing? In fact, there is no any relation. The only link is just myself. But I thought that we can take this opportunity and take this DCA Dynamics, take DCA Dynamics as an opportunity to share with you something that I think it's really useful for life. And at the same time, if you want to support us in the development of this project, we accept donations because we are supporting with these 4 companies, but we need also to fund additional things in this educational purpose. Because for you to know, we are currently on a program with the European Space Agency called Fly Your Thesis. And this Fly Your Thesis campaign will allow us with a prototype we are developing, allow us to test the technology and see that our technology is faster and less energy consumption than the current one. So we will really appreciate if you want to collaborate with us. So in principle, there is a banner over here or over here, I don't know, in which you can donate whatever you want. So let's go directly into the detail of this investing masterclass. I want to make some agenda of what are we going to cover through this masterclass. Basically, we are going to start with a quick introduction on investing and on how to manage your personal finance. And then we are going to cover some investment types and investment portfolio that you can create. And after that, I want to share with you a simple way to how to pick up stocks, how to pick up new good opportunities for investing, and finally how to manage risk. And in the end, I want to recommend you some books that I read some time ago, and I really like them. In fact, I want to read them again. So I think you also will like them. And in fact, I think that learning is the key of life. So I take this as an opportunity to share it with you. And finally, the idea is to make some Q&A session through the chat. You can comment whatever you want to clarify, or you want to know something, or whatever. And at the end, we are gonna go through the chat and try to solve, or at least to share with you my knowledge about it, what you wanna know. Okay. Okay, so first of all, in this introduction, I want to disclaim something and it's that I'm not your financial advisor, and this cannot be taken as a financial advice. It's really important that you know in what you invest, and you take own your responsibility of your decision. So please, I can share with you everything I know, but do your own due diligence and take responsibility of your own actions. Okay. So to start, I liked this quote from Gordon Gekko. Gordon Gekko is a composite character that Michael Douglas was interpreting in Wall Street film. This is not a real person, but I think this message in that field is really, really good. A fool and his money are lucky enough to get together in the first place. So if you don't know in what you invest and you just follow the trend, the probabilities that you will lose money are really, really high. So that's the reason that this disclaimer is really important, because you need to take responsibility of your own decisions, and you need to know what you are doing with your money, because it's really difficult to earn that. So please don't waste it. Okay. So let's start with the investment types. Which kind of different investment types we have, or at least I know and I use. And there is some stocks, bonds, peer-to-peer loans, real estate, cryptocurrencies, commodities, and forex. I'm absolutely sure that some of you will be really excited about cryptocurrencies. I don't know so much about cryptocurrencies, and I personally, to be honest, I don't like them so much. But we're going to talk about them a little bit, just for you to know my impression and my perspective on this. So we're going to go through each one of those. And apart from knowing the types, I want to share with you different strategies that we can apply when we speak about investing. And the idea is to going into this each one of those, see which kind of strategy we can apply for every investment type. Okay, so first of all, there are passive or active strategies. A passive strategy is basically trying to maximize the return, minimizing your action in the investment. For example, if you give a loan to someone, you have just put that money into that person, and that person will pay you monthly, yearly, the capital, and also some interest on that capital. So this is absolutely passive income, or passive strategies, let's say, because you put some money and you don't have to do anything else to earn your interest, your gains, and so on. Active is completely the opposite. An active strategy could be, for example, when you buy and sell so much during the day or during the week. So maybe trading is on this active strategy. Okay. We can have another strategy, which is growth investing. Growth investing is basically invest on companies or whatever that have a high growth rate. For example, Airbnb, Tesla, these technological companies that are experiencing during the last years a high growth rate are examples of investing in growth investing. Okay, so it's basically as the company is experiencing a high growth rate, we expect that to also happen in the future. So we value that company so much. At the same time, the growth rate companies, for example, are also riskier than other ones, because you cannot maintain the same level of growth rate through your whole life. When you are starting, it's easier to go from 1 to 2, and you are having a 100% growth rate. But if you go from 1 million to 2 million, it takes so much effort. So a high growth rate is not easy to maintain. Then we have another strategy, which is value investing. Value investing it's basically analyzing a company. And when you analyze this company, you identify that there's some intrinsic value. So the things and everything in life have some value, have some intrinsic value. And then there are people in terms of offer and demand, or just tendencies, or just whatever. Sometimes you find that thing maybe for a discount, maybe overpriced. So when you have a value investing strategy, the idea is to, and we are gonna go to this example when we are gonna try to analyze one stock. You are trying to identify the intrinsic value of a company, and later on you will see, okay, this company values at $80, for example, but currently the price on the market is $100, so it's absolutely overpriced. So you don't buy that company. But for example, if you identify that the intrinsic value is 200 and the current value is 100, you are getting a 50% discount. So in the end, the financials of a company doesn't lie to you. So it's better to trust in the financials and not trust in what people are doing, because people are crazy. Okay, so take this as an advice, and we can go then later on into some more detail. We have also another type of investment, which is income investing. Basically, you try to get an income from your investment. For example, real estate investment. For buy and rent, you receive an income. So you having an income investment. This can also apply to companies. If you go for a dividend investment, for example, you put some money in that company, and you receive dividends for that. You can have also indexing. Indexing is really, really interesting, and I really liked it. I really like it, and you will see later on. Because instead of putting the effort selecting the companies and so on, there is some kind of index which reflects the economy environment and how it performs. So at this, instead of buying just one company and putting all your eggs in the same box, you buy a whole set of companies. So you are diversifying, and you are reducing your risk. We will go into detail later on also. And we have the two last ones, which is dividend growth investing. So this is a combination of an income investing and a growth investing. So at the same time, you are receiving dividends, and you expect those dividends to grow. And finally, contrarian investing is just go against the market. So when everybody's selling, you buy, and when everybody's buying, you sell. Because as I told you before, people is always crazy. Okay, so let's go into these different investment types. So first of all, stocks. What is a stock or a share? It's exactly the same. A stock or a share is a fraction of a corporation, of a company. So this is absolutely critical, because when you own a share, when you buy a share, you own a portion of a company. So you will receive the earnings if they do well during the year and they have some earnings during the year, they will share with you those earnings. But if they do bad and they don't have earnings, or they have losses, or whatever, or the company goes bankrupt or whatever, you will lose your money. So it's exactly the same as if you are owning your own company, but just a fraction of it. Okay. Taking into account that, taking into account that stocks have a higher potential return in comparison with other kind of investment, but the drawback here is there is no guaranteed returns. Although if we have a dividend strategy, for example, this is not guaranteed, because if the company do really bad, there is nothing to share between the shareholders. Okay, so there is no guarantee return. And you will see what I mean by guarantee later on with the bonds. Normally, this kind of investment have an average annual return around 7%, and you can apply different strategies that we were commenting before. Passive or active strategies. You can have a buy and hold strategy, just buy a stock because you think it's undervalued and hold it around the time, or maybe you know that a stock is really good and stable and good. You know the business model. You know that is absolutely established. For example, Coca-Cola, and it has a really good dividend shares. And so on and so forth. So you just buy that company in order to hold it during your own life. Okay, and against that you have trading, and you just buy and sell in order to go for capital gains. We need to be careful with this, because on stocks the taxes are really high. So every time you buy and sell, you need to pay around 20% of the capital gain, or reduce those losses if that's the case also. But it is really important, and that's the reason I really like funds, because when you use funds instead of stocks, you avoid this tax fee. Okay, we will go later on a little bit more on the detail when we cover funds. Then you can also apply a growth investing strategy for companies, for example, like Tesla, Airbnb, we were discussing before, Google, whatever. Value investing, we commented before. Some indexing or funds, and we will see right now why an index and what are the main index I use. You can use also dividend growth investing and contrarian investing, just going against the market. And when everybody's selling, you just buy because you think that company is good and it is on sale. So you do your math and go well. Okay. So we were talking about dividends, and I just want to clarify what is a dividend. A dividend is just a distribution of the company earnings, okay, to every shareholder. So if the company earns 5,000 and it has 500 shares, so every shareholder will receive 10 euros. Okay, if they are sharing between the shareholders all the earnings. Usually, companies what they do is just share a percentage of the dividends, or for example, the growth companies we were commenting before, instead of sharing the earnings, they invest the earnings into increase the business. So this is another way to increase the value for the investor. Okay, and normally you are eligible to those dividends just if you own the stock before the ex-dividend date. Okay, so if for example on Tuesday will be the ex-dividend date of Airbus, for example, you can buy the stocks on Monday, and in principle, you will receive the dividends on Tuesday. Okay. And we were talking about indexes also. So what are the indexes? So these are the ones I normally use. And this, for example, the first one is the S&P 500, Standard & Poor 500. What does this index mean? This index is covering you the best 500 companies in the USA. Okay, so if you buy this fund, or this index fund, when you use this index, instead of buying one company and putting all your eggs in the same box, you are buying the 500 best companies in the USA at the same time, and for a good price, because it is not like assuming or plusing the whole action price or the whole share price. It's just you buy the fund which is managing your money, and they maintain the percentage of every single company in order to be able to monitor what the US market is doing, US stock market is doing. So basically, instead of buying a company, you are buying the behavior of the economy. So in principle, you will have the same return as the whole economy itself. So the probabilities that these numbers were absolutely down to zero are so low, because in the end, if one company, for example, from the S&P 500 goes to zero, this company will be replaced for another one who covers these 500 best companies. So in the end, it's a good investment approach. So these are the index I use usually. The IBEX 35 is the IBEX 35. Sorry, are the 35 best companies in Spain. Stocks 1,800 is the 600 best companies in Europe, 600 best companies in USA. Stocks 600 EU is the 600 best companies in Europe. Eurostoxx 50, Euronext 100. You get the idea, right? And finally, we have this index, the VIX index, which I really like in order to have a contrarian investing. Okay, the VIX index is always referring to the panic of the market. Okay, so you can see on the right hand side the behavior of the VIX index during 2020 and 2021. Okay, and you can see there is a peak, an absolutely big peak on more or less, but this is not more or less. I can tell you for sure, and you can look for it. This is March 2021. This is exactly when COVID appears, and when people were panicking about how the economy will evolve. Okay, so in the end, this index increase when people is panicking and selling all the stocks absolutely at any price. So this allows us to identify opportunities to have a contrarian investing, because if you invest on those moments when everybody is selling, the probabilities to have a higher return would be really high. Okay, and finally, the funds, as I was telling you before, and I don't want to get into the detail, is just a financial opportunity in order to be able to manage the company of different investors, but at the same time, the investors are having the ownership of their own part of the shares, so they can decide if they want to sell or buy at any time. And at the same time, it's providing more investment opportunities because you are buying different companies at the same time, lower investment fees, and so on and so forth. Okay. So we were telling before that stocks is in comparison with bonds, and stocks are a little bit riskier in comparison with something, and this is the bonds. What is a bond? A bond is a corporate or a government loan at a fixed interest rate. So it's basically that we are acting like a bank for a corporation or for the government. So you loan your money to the corporation or the government, and they will pay you through the years through coupon payments for that bond. So and the probabilities to, for example, the government to not pay you are really low. So that's the reason this type of investment is safer than stocks. But when you go for a less risk, you need to know that you're going to go for less average returns. So in terms of bonds, the average return is 2-3%. So you are more or less saving the inflation of the whole economy. And which kind of strategies we can apply? Passive or active strategies, or the indexing, or funds that we were commenting before. You can buy at the same time different bonds on Europe or in the world, or just in the USA, whatever. There is an alternative to bonds, and I really like it, which is P2P or peer-to-peer loans. I use one platform, and this platform is Mintos. And basically, in this platform, Mintos is acting as a middleman between investors and loan originators that finally give the money to the borrowers, to persons like you, me, and everybody in the world. So there is a lot of loan originators that provide mortgage loans, car loans, invoice financing, business loans, short-term loans, personal loans, agricultural loans, any kind of loan, and they take your money basically and diversify between every single loan, and give it to the borrowers at the very end. And I'm pretty sure you are thinking, okay, but in this case, the borrower is not the government. The borrower is a person, and this person maybe is suffering the consequences of COVID, and they are not going to pay. So in the end, my money is on risk. And you're right. But the thing is, Mintos, with these companies, is having in some of the loans, having what is called buyback guarantee in order to save the investor side. This buyback guarantee what basically do is, when you have some borrower that doesn't pay you the loan in more than 60 days, the company itself takes the responsibility and the accountability to give you back your money. And then later on, they will have any kind of legal or whatever action with the borrower. So in the end, the investors are not completely secure, because there is no investment in the world that offers high profitability or return without risks. If you are looking for this, I'm sorry guys, but this doesn't exist. You need to take risk if you want to take returns. So, but although you need to take risk, it is safer if you know that the companies will apply this buyback guarantee. And this investment type, which you will see later, I use a lot. It's having around 10% average annual return. Okay, so let's go for real estate. Real estate. In real estate, the problem here is the big investment upfront that it requires. So in the end, it is reducing a lot. It's reducing a lot the persons that can apply for this kind of investment. But I will tell you some alternatives that I'm pretty sure you would like it. When you buy or you decide to invest in real estate, you can have different kind of business models. If this is an investment, if you want to just to buy a home just to live, this is completely understandable. But we are looking at buying a home just to make some profit on it. So you can have two different investment types: just buy the apartment or whatever to rent it, or just house hack it. What is house hack? House hack is just to buy a whole apartment with more than one bedroom, two bedrooms to whatever. And the idea is to live in one of the bedrooms and rent the other part of the house. So in that way, you take a mortgage to buy that house, and the idea is that the rest of the roommates with the rental pay the mortgage. So in the end, you are kind of living for free. Okay. I really would like to do so, but at this point, I don't have the opportunity to do it because of the big investment upfront. But this is one of the my main ideas for the future. But just to share it with you. Real estate is also a safer investment than stocks, because it's something that always people demand somewhere to live. And because of that, the average return is around 3-4%. There are some financial tricks that can increase that return, because if you put some less money up front, you can increase the average return and so on. But just as an average, around 3-4%. Okay. And I'm gonna tell you in which I'm investing right now, and this is an alternative for real estate, and this is called Real Estate Investment Trust. Okay, these are companies that are in the stock market, that they are basically buying. Their business model basically is just buying homes and rent them, or buying homes and sell them with a capital gain, or buying homes and sharing between different as a Airbnb approach, or whatever. So basically, as this is the business model of these real estate investment trust companies, you just buy shares of that company, and basically you are getting as a dividend the result of the rental in the proportion that you are investing, but you are getting the rental at the end, because these companies, instead of going for a one or twice per year dividend shares, in this case of rates, they make dividends almost every month or every quarter. They are sharing the dividends because of the rentals, because the rentals appears every single month. Okay, so that's a really good approach. And as I told you, this doesn't require a big investment upfront. Okay, cryptocurrencies. Cryptocurrencies. So as I told you, I don't like them so much because of the high volatility. But it doesn't imply that I don't invest on them, because I think at least you need to be diversified. So if everybody is thinking that this will rocket, maybe it makes sense to have some money there. And basically, Bitcoin is a decentralized digital currency, considered as a potential store of value. It's like comparing Bitcoin with the future gold. It's because it's limited, and so on and so forth. There is, apart from Bitcoin, there is another altcoins, which are alternative coins, which in general, they are basically projects that create some token in order to fund the project at all, or the technology or whatever. So in the end, it's like the old funding recover or something like that. So the risk here is that as it's like a startup or whatever, it can go absolutely to zero, because there is no so much value inside that apart from the project they are developing. If the project goes well, you can get rich. Yeah, it's exactly the same as you own a startup. But if the project goes bad, you can get bankrupt. And apart from that, there is another token. There are another tokens that are DeFi. This is the decentralized finance, and what they want to do is just based on smart contracts. No need of intermediaries when you request a loan, and so on and so forth. So, in my opinion, the future is on this DeFi, but it's hard to say. And different applicable strategies, you can use passive or active investing for Bitcoin, and also in terms of altcoins, you can invest over there. Like if you would invest in another startup, but you need to know that it can go to zero, and you can lose your money. Apart from what we have covered, we have commodities, which is basically a hedge against inflation. And we are talking about gold, beef, grains, oil, whatever. And basically, their return is really, really low, just to cover the inflation, like bonds or something. And the average return is around 3%. And finally, FOREX, which is basically exchange of foreign currencies. Okay, you can just trade between different currencies, and you can do this, for example, through Revolut. That Revolut is not taxing you because of this exchange rate. So it's a good opportunity to try to identify trends. But you need to be careful, but because the same as was happening with the stocks, when you exchange foreign currencies and you earn money on the process, you need to declare it to the tax agencies, and you need to also pay a fee, also around 20% of capital gains. So you need to be careful. So we have covered. Let me drink some water. We can have a short start, and we can see the chat, just to know if you are joining it and so on. Let me. Are you guys joining the class? I cannot see any comment. Hopefully everything was going well. I cannot see any comment. Let me check if something has happened. Okay. Okay. Sorry. I was worried that something happened. Okay. So. Okay. So let's continue, and we can go for your questions later on. Okay. Okay. So let's continue. Investment portfolio. So we were talking about different investment types and how can you invest on some of them. But I'm pretty sure that you want to know the details and some example of rates, some example of companies, and so on and so forth. Okay. So first of all, I want to share with you one quote of Ray Dalio. Ray Dalio was a billionaire investor and a hedge fund manager. I really liked this guy. And one of his quotes was, "You should have a strategic asset allocation mix that assumes that you don't know what the future is going to hold." Okay, so what is basically under these words is that you need to have a balanced portfolio that in the end you don't need to worry or if the economy goes well or goes bad, because your portfolio will be well in any kind of environment. So that's the purpose here, just to take the more of the bull markets, but to take the low of the bear markets. So don't lose money. That's the purpose. And based on this, Ray Dalio created what he calls the perfect portfolio, or the all-weather portfolio, like he calls. And he indicated the percentage you need to have from every kind of different investment type we were discussing before. And you need, as he considers, you need to have a 30% of your portfolio in stocks, and this compensate with a 55% in bonds, 15% in intermediate bonds. Intermediate bonds is like loans from 5 to 10 years, and long-term bonds is long-term bonds is loans, government loans or corporate loans for more than 10 years. Okay, so this is just to balance the portfolio, having a 30% of stocks with a little bit high risk but high potential returns, and the bonds with low risk but low potential returns. And finally, in order to cover against inflation and so on, having almost 15% on finance instrument to cover against inflation. 77 around 7% of commodities and around 7% of gold. And I also take this opportunity to share you guys with you this video. I don't want to put it over here, but I really recommend this video to you guys. This is on YouTube, and this is how the economic machine works from Ray Dalio. It lasts 30 minutes, but you will absolutely understand the basics of economy. Okay, but some time ago, one of my friends, I was discussing with him about this and so on and so forth, and he was telling, okay, but this is just theory. But in what you invest, what is exactly in what you are investing? Okay, so it's basically what I'm going to share with you right now. So this is my portfolio. It's not exactly like the Ray Dalio, but it has some reasons behind them. So this portfolio has, during the past 2 years, 20% average annual return. And in this case, I consider myself with more resistant to risk. That's the reason stocks are in a big percentage, like Ray Dalio. It was stating 30%, so I stated a little bit increase in order to gain more potential returns. Instead of always going for bonds, I prefer these Mintos, as I was telling you before, this Mintos platform, in order to compensate the stocks with a coupon-based investment. Although I'm having around 5% in bonds, around 1% in gold to cover against inflation, around 2% in real estate investment trust, and finally around 2% in cryptocurrencies. You need to take into account that this average annual return is not taking into account, this 20% average annual return is not taking into account cryptocurrencies. Because as I told you, I consider cryptocurrencies really, really volatile, and I'm just owning them just to see what happens, to be honest. So because in fact, if I would put cryptocurrencies on this average annual return, the average annual return would be around 200%. Okay, so it implies a lot of disruption in the numbers. So I prefer not to count cryptocurrencies. And this is basically my portfolio. We are going to go through each one of my different investments, and see the different approach over here. Okay, so first of all, we have Mintos. As I told you before, it's around 37% of the portfolio. Just for you to know, the table is structured like description, which is the company or what is the fund or whatever. The type, if it is a stocks or a bonds, alternative bonds, rate, cryptocurrencies, whatever. eSIM code or ISIN code. This is basically an unique code in order to identify that exactly company or fund or whatever. And finally, the portfolio percentage in each one of those. So first of all, Mintos. Then we have Airbus company with 6%. Banco Bilbao Vizcaya, which is a Spanish bank, which I like. So that's the reason it's 5%. Vanguard S&P 500 UCTS ETF. So basically, this is the funds we were discussing before about the S&P 500. So when you buy this fund, you are buying the 500 best companies in USA. Okay. Banco Santander, which is also basically another bank in Spain. Calum Petroleum is a company, a petroleum company in the US. In this case, this is a riskier investment because it's a company with a lot of debt, but with higher potential returns, and I liked it. So that's the reason it's on the portfolio. But if you analyze the financial, you will see that the company is risky. Telefónica is a telecom company. American Airlines and Delta Airlines, two US airlines. iShares Core S&P 500 ETF. This one is exactly the same as Vanguard's S&P 500 UCITS ETF. It's exactly the same, but managing with a different company. Okay, so in the end, you are buying the same, but the companies are taxing you different. So I'm just owning both of them in order to see what fund works best. Okay. GoPro, another US company, ones for the cameras. Lixor Core Stocks Europe 6500. It is covering the 600 best company in Europe. Bitcoin on cryptocurrencies. I only invest in Bitcoin right now. iShares Develop Real Estate Index Fund. And this is a rate. Instead of buying concrete companies on real estate, I prefer to buy a rate fund in order to have exactly the same, but with different companies. Snowflake is a service, cloud service provider, which I liked, but it's not working so much well. But I'm pretty sure that they have a good and a strong business model. And the problem with this investment is a growth investing one. So it's a companies that are increasing a lot. In fact, taking into account that because of COVID, all digital companies are absolutely on the lead. And then we have another ones, which is ESER's Core MSCI Emerging Markets Investable Market Index Fund. Basically, this one, instead of buying on the best 500 companies or whatever, is investing on emerging markets, on markets with higher potential returns, but higher risk. And instead of buying just one company on this emerging market, you are buying a whole set of companies. That's the reason the portfolio percentage is a little bit low, because it's riskier than the other ones. The next ones, government bond, corporate bond, and aggregate bond, are ETFs for bonds, for government, for corporate, and for both of them, the three ones. And instead of buying just one bond, it's an ETF which covers a whole set of bonds. FTSE Developed Europe ex-UK and FTSE Emerging Markets. These are basically, the first one is on the UK stock market, the best companies, and the second one is in the UK stock market, the emerging companies that could happen or could appear. Then after that, I have a search from Boeing, another aircraft company. As you see, I prefer Airbus. That's the reason I work for them. Vanguard, Eurozone government bond. This is another bond, whole set of bonds, but it is only in Europe. Invesco Physical Gold. This is for gold invest. Instead of buying just gold, I prefer to buy some fund that invest in gold. So in the end, it's exactly the same. MSCI Japan UCT ETF. This is basically for Japan, the best companies on Japan. FTSE Developed Asia Pacific ex Japan. So this is for Asia Pacific. Japan INI for Japan. FTSE 100, the 100 best companies in the UK stock market. And finally, two bonds to cover inflation, that they are investing in some kind of commodities and gold and so on. Okay, so this is my whole portfolio. This is being recorded and will be on LinkedIn and YouTube, so you can access whenever you want to all this information. Okay, so I'm a little bit late. It's 1 p.m. But no worries. I think it's not taking more than 10-15 minutes to finish, and then we can go for the Q&A. So we just see different investment, different opportunities, different portfolios. So I want to share with you guys right now how to pick up stocks and how to select companies if you want to invest yourself. You can, as I told you, you can invest directly on these funds that basically are covering the whole economy. But I like to balance this with my own decisions and trying to select companies that I like and I want to and I think that they are good and they are undervalued and so on. So first of all, as we were discussing during the masterclass, Peter Lynch, another American investor, states that you have to know what you own. And this is absolutely true. You need to know exactly what is the business model behind that company, understand it, and then look at the financials and see if that company is doing well or doing bad. We are going to focus on value invested, as I told you before, for this simple way. There are a lot of ways to value companies, but this is the simplest one I was using, but this is the simplest. And this guy over here is Warren Buffett, one of the best investors in history. And he states what is value investing, and he states 4 things that you need to know and you need to look for. A stock must be stable and understandable, exactly the same as Peter Lynch was telling us. You need to understand it, you need to understand the business, you need to know where the money comes from, and so on and so forth. A stock must have long-term prospects. The company needs to have a future in the end, because if not, you are investing in just nothing. So it needs to be a company that have long-term prospects. A stock must be managed by vigilant leaders. So it's really, really important, the CEO of the company, because there are a lot of examples and a lot of cases in which a really good company, but leading with a bad guy, not bad guy, but that doesn't manage the business well, goes bankrupt. So it's really important that the CEOs, the board of directors, are the best ones. And finally, and this is in relation to margin of safety, the stock must be undervalued, because we want to buy something when it's on a discount rate. Okay, so how to pick up stocks? In order to value the stock, we are gonna go through 2 steps, or maybe I didn't explain myself correctly. In order to value the stock, we are gonna go for the step 1, but in order to pick up the stock finally, we are gonna go also for step 2. Okay, so for step 1 is calculate the intrinsic value, what the company values in the end. So you need to know how much cash will the business make for you in the future. So it's like recurring cash you are gonna get, or maybe not you, the company in the end. And what are the future cash flows worth to you right now? Because it's important to discount every cash flow to the present, because it doesn't have the same value 1,000 euros now than 1,000 euros in 1 year, or 2 years, or 3 years, because there are a lot of inflation, a lot of opportunity cost, and so on and so forth, that you need to take into account. And finally, when you evaluate the stock, you need to calculate a margin of safety, because we can't 100% rely on our predictions. So and in the end, on our estimation. So in order to be on the safe side, we need to apply a margin of safety. So how to calculate intrinsic value? In order to calculate intrinsic value, we are gonna go for the free cash flow. Free cash flow represents what a company generates in terms of direct cash after subtracting the cost for operations, or the operation cost, and the cost of maintaining and growing the business. So these are let's say keywords, but don't take the operating cash flow, free cash flow, capital expenditure, just to take the idea of what we are doing. And operating cash flow is the cash flow that the company generates directly from its operations, and capital expenditure is this one, this money that the company needs to continue operating and grow the business. So we will subtract those numbers, we can get the free cash flow. And we're gonna look for an example. In this example, we are gonna try to evaluate Apple company. And these graphs you see over here are taken from ticker.com. Ticker.com is a really good website, and it's basically taking all the financials of every single company and make easier for the investor to analyze the data. and also sometimes make all these calculations for you. So it's absolutely easy to use them. So if you enter into ticker.com and you sign up, you click on the Apple ticker and see the different financials of Apple: income statement, balance sheet, and cash flow statement. If you go for in the cash flow statement, you will see a line which is called cash from operation, the one highlighted in blue. This cash from operation is just directly the free cash flow. So we can also see the evolution of the free cash flow during the years. So maybe we can estimate an evolution during the following years. For this example, we are going to take the simplest as possible in order for you to know and to understand. So we are going to look for the last 12 months, okay? Instead of looking for any one of those, we can do the calculations in any year, or just to make predictions on what the cash flow will be and so on. We are going to look for the last 12 months, okay? LTM. So if you look at cash flow operation, is 80,600 millions of dollars. Okay, this is the operating cash flow that Apple generates more or less every single year. So if we look also in this cash flow statement for the capital expenditure, this is around $7,000 million. Okay, so this is the money Apple needs in order to maintain and to continue operating and grow the business every single year. This is without taking into account taxes and so on. If we want to take also into account, we can calculate the free cash flow and just subtracting, and this will be the free cash flow without taking into account taxes and so on. If we take into account taxes and so on, we can make some numbers and so on, but it's easy to go immediately to valuation multiples in this same website, ticket.com, and look for the last 12 months levered free cash flow. This is just the free cash flow, but subtracting the taxes, interest, and financial expenses. So in the end, the money that it's on cash in the company is around 60,000 million US dollars. Okay, so you can see over here that more or less the expenditure in taxes, interest, and financial expenses is around $13,000 million. Okay, so we have calculated the levered free cash flow. So we just know right now how much money the company generates. So how to calculate the value of the stock? So this money that the company generates would be we can suppose, in this case, we are going to suppose that is exactly the same during the following years. But for example, you can have a cash flow of $60,000 million on the first year, but this increase on $65,000 million on the second year, and so on and so on. In order to calculate the value of those cash flows at the present time, we need to discount those cash flow, and this is the formula we are going to use. Discounted cash flow is equal to cash flow 1 and divided blah 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 blah. El cash flow is just the cash flow it generates, so the $60,000 million, and the R is the discount rate at which we are going to discount the cash flow. In this case, as we want to have a good investment, the rate in which we are going to discount the cash flows is the expected average return that we want as an investor. Usually, taking into account that the stock market is generating around 7% every single year, so we are going to establish 7% as a basis. And we can have this equation simpler just supposing or making the hypothesis that the cash flow will remain the same over the years. If we suppose that the cash flow will remain the same over the years, the equation is just as simple as discounted cash flow is the cash flow, the $60,000 million, divided by the discount rate, in this case, 7%. Okay? So if we do that, we are going to calculate the discounted cash flow. But this will be for the whole company. So in the end, what we want to compare to is for the value of the stock. What we see when we go to our bank account or whatever, I want to buy some shares of Apple. Oh, it's about 100 US dollar, 130 US dollars. We need to compare with that number. So in order to do this, we need to know how many shares are in the market. So in order to show how many shares are in the market, in the same website, you look for my mouse is not working. Let me. Sorry. No, I cannot use the mouse on, but I will show you over here. On the summary on this website, you can identify the evolution of the price of Apple during the last 52 weeks. The shares outstanding, which is the number of shares that the company is having, in the end, the market cap, and some additional ratios and so on that we are not going to enter into the detail. What it's important for us is this shares outstanding. So if we calculate the discounted cash flow by dividing this free cash flow, $60,000, by 7%, and we divided this discounted cash flow by the shares outstanding, this number over here, we have a final valuation of Apple of around $50 per share. So currently, Apple is on the market at about $100 per share. So this indicates us that Apple is completely overvalued. So if we buy shares of Apple right now, we are buying something that cost $50 at $100. I put you a simple example. Would you like to buy a pair of jeans which cost $50 at $100? What would you do that? So just to have this reflection at the very end. So in the end, we have just calculated in the simplest ways possible how to calculate intrinsic value of a company. Once we have calculated intrinsic value, and suppose that we are, instead of being overvalued, we are undervalued. So we need to establish a margin of safety, because in the end, you have calculated the intrinsic value. So in the case of Apple, we are over here because the intrinsic value is $50, but the value of the market is $100. So we don't want to buy. We want to buy when the price is over here. So we are going to establish a margin of safety in order to buy over here. So Warren Buffett, the investor I was telling you about before, is an American investor and CEO of Versaway, one of the best funds in the world. The three most important words in investing are margin of safety. This also applies for Benjamin Graham, a British economist, professor, and investor. The function of the margin of safety is, in essence, that of rendering unnecessary and accurate estimate of the future. And another example, Seth Klarman, American billionaire investor and hedge fund manager. A margin of safety is necessary because valuation is an imprecise art. So you need to not be perfectly trustworthy on your predictions. So, and the future is unpredictable. So, and investors are humans and do mistakes. So it's important to apply some margin of safety in order to identify perfectly what is the price you want to buy to buy that company. So in the end, instead of buying an intrinsic value, we state a margin of safety, and we buy when the price is here or below, because we know that in some time the company will reach this value, because its value, it's its intrinsic value. The company is generating enough cash flow to reach that value. So the probability that the company goes in this price are really, really high. Okay. So finally, that we have talk about how to pick up stocks and different investments and portfolios and so on, how to manage risk in investing. So for me, it's just as easy as make a plan. You need to make a plan. If you want to invest $1,000 or 1,000 euros in this case, sorry, instead of buying it upfront, just make a plan. For example, you want to invest 1,000 euros. So instead of buying everything at the same time, at the very beginning, you make a plan and you are going to invest every single month 100 euros. You know that the company is undervalued, or you want to invest on funds, or you want to invest on Bitcoin. This applies for every single investment. You are going to absolutely have the best performance, because this is the evolution of the price. Okay, so if you buy 1,000 euros upfront at the very beginning, you are gonna lose these opportunities over here, and the probabilities that you identify perfectly when is the lowest possible time to invest and to have the best performance. This is impossible, because it's impossible to predict how the market is gonna evolve. So what is key is, okay, I'm gonna invest $1,000 during 1,000 euros during the year. Okay, so I'm gonna invest 100 euros the first month, 100 euros the second month, 100 euros the third month, 100 euros the fourth month. In that way, when the price is going up, you are getting less shares. But when the price is going down, you are getting the higher amount of shares. So in the end, you are getting the best performance ever that it could possibly happen. And this is what I absolutely recommend you guys to make a plan and strictly commit to it. And another way, which I combine too, is just to make some contrarian investing. So look at VIX, and when everybody's selling, you just buy, and when everybody's buying, you just sell. This is perfectly to identify opportunities and to identify the best way to invest. Okay, so just to finish the masterclass, I want to recommend you some books. I read it through the years, which I really like them. I have selected four books. So and as Warren Buffett was saying every time, the best investment you can make is an investment in yourself. The more you learn, the more you earn. So it's all about what you know. It's all about what you learn. It's all about what you decide to improve personally. So it doesn't matter what kind of job you have. If you take your time to improve and to be always better, you will be better in the end. So first book I'm gonna recommend is Rich Dad Poor Dad from Robert Kiyosaki. In this book, Robert Kiyosaki focuses on the mindset you need to be better with money. So it's a completely 180 attitude change, and this reminds me from DC Dynamics. So it's an absolutely 100 attitude change in life. So because you change absolutely how you are gonna behave in terms of financial decisions. and teaches you the importance of cash flow, because it's important to know the difference between bad debt and good debt. You can take a loan if that loan are gonna be are going to give you some income from that loan, but if that loan is taking money out of your pocket, it's a bad loan, it's a bad debt. Because, for example, taking a loan for buying a car is taking money out of your pocket directly from the very beginning. So it teaches you the importance of this cash flow. Discusses the differences in how people use that cash flow, this good and bad debt, and teaches the importance of buying cash producing assets. This is what we were commenting right before, the income investing approach. Atomic Habits from James Clear. This is not directly related to investing, but this implies exactly what I was telling you just when we were starting discuss about the books. You need to be 100% better every single day. If you are 100% every single day, 100% better, during the whole of the year, you are going to be around 40 times better than when you started the year. So it's not about big changes, it's about tiny changes that making your life so much better. So when it comes to get fit, for example, it's not about suddenly go to the gym and stay over there 3-4 hours every single day, because we are not gonna create an habit over there. So it's just to a small step by a small step, you are gonna increase in your performance. But this applies not only for personal performance, but for everything in life. And it's this book also teaches you how to create a good habit and how to break a bad habit. And how to create a good habit is you make it obvious, attractive, easy, and satisfying. And in order to how to break a bad habit, you need to make it invisible, unattractive, difficult, and unsatisfying. In this book, they teach you different ways to do so, and it's absolutely good. And this also applies for investing, because if you instead of saving a lot of money at the very beginning, you just save a little amount of your income. Just you can start by 50 euros or something and invest those 50 euros in a fund or whatever. It doesn't care on how money or how many money or how you do that. It's a matter of going little step by little step. This book is One Up on Wall Street. This is directly related to investment, from Peter Lynch. In this book, Peter Lynch teaches us how to categorize stocks and what to know for each one of those. In this book, it's another. It is explaining another valuation method that we used over the masterclass. In this case, is a valuation method based on multiples. In this case, there is some kind of average multiple for the free cash flow, or for the EBIT, or for whatever, for the earnings, average numbers that operate in the market. And the idea is to create those ratios for our company and compare to them and see if the company is overvalued or undervalued. Okay, but this is another valuation method, a little bit more complicated. So, and it states the numbers to check to ensure you are making a good investment, and these ratios. How to avoid bad stocks, because it's not only about buying the best stocks, is to avoid the bad ones, because it is so much easier to lose all your money if you get 100% lose and you have that limit. But when you are earning money, you don't have any limit. So It's about avoiding bad stocks, because starting from scratch is really, really difficult. And how to construct a bulletproof investing thesis. So in the end, how to create a portfolio, as Ray Dalio was telling us before, in order to avoid to think about how the economy is behaving, because our portfolio is strong enough to support everything. And finally, the intelligent investor from Benjamin Graham. He told us never trust Mr. Market. Mr. Market is exactly what I was telling you. When everybody's selling, when everybody's buying, this is Mr. Market. So he can be very irrational. So the idea is to go against Mr. Market, stick to a strict formula by which you make all your investment, and you'll do fine. And 3 principles: analyze the long term, protect yourself from losses, as Peter Lynch. So avoid bad stocks, protect yourself from losses, margin of safety, and don't go for crazy profits. It's not about making a lot of money. Make less average returns, but the idea is that a compound interest would be doing the rest during the years. So thank you so much for this meeting, to attend this masterclass, and I want to start right now. This is our funding platform, in order, if you want to donate us, and I want to give the opportunity to give you the opportunity to ask whatever you want. So I'm gonna stop sharing. Okay. So first of all, I don't know what's happening, because I'm not seeing the chat. I cannot see the chat. I don't know what has happened. Oh, this is a pity. I think I need to know to LinkedIn and sorry for this, because something has happened with the linkedin.com. Yeah, because it's thank you guys, thank you. I'm seeing the current chat. Thank you, Miguel, for your words, but it's absolutely a pity, because I have lost the comments, but I'm gonna enter into the DCH dynamics and trying to look for these comments. 62 comments. Okay. So I'm trying to go for let me try to read some of those. One comment or one question. Jesus Manuel Muñoz Tejeda. If the 500 best companies change, do this stock change to be updated, or is it a fixed list at the point you invest? The good thing here with the index funds is that they are absolutely rebalancing and changing the companies at the index change. So if you buy the index right now, over 3 years, you will own the best 500 companies at that point. So it is not fixed. It is evolving as it is the market. Okay. So maybe some questions. Oh, a lot of good messages. Good, all good. Thank you so much for this support, guys. Rate suggestions. Jorge Lavín Montoro. I present you some fund of rate. You can have the easing code, but I can give you also some examples of rate. One of those is Merlin Properties. Merlin Properties is one rate company in Spain. And another one, this is the reason I was, because I've never remembered the name, is New Residential Investment. It's an US company. And I'm right now tracking those, both of them. But as I told you, at this point, I'm investing on rate funds rather than investing directly on a company. Okay, more companies. What is your investing as strategy when it comes to crypto? Pretty small low. Right now, my investing strategy in terms of crypto is just to fix an amount of money and basically invest every single month the same amount of money. This is just to, as I told you before in this last slide, in order to find the dollar cost average and trying to get the best return possible. But as I told you, I consider crypto as a really high volatility investment. So I'm not investing so much on this. So I fix a really low amount of money in order to use this cost dollar cost average strategy. Daniel Bercerra is asking if I'm taking into account the relationship between funds in order not to duplicate the investments. As I told you right now, I'm investing, for example, in two different funds, investing in the S&P 500. So they are investing exactly in the same companies. So right now, I'm just trying to look for the best one. And then after that, I will go for avoiding duplicities. Okay. More questions. A lot of questions from Jesus. I'm trying to look for additional guys to give them the opportunity to solve the questions. Okay, so it's basically Jesus questions. I'm gonna go through one of them. Daniel is telling that the best crowd lending company is Mintos, but he's asking if I don't diversify between crowd lending platforms. I tried some lot of those, and I prefer Mintos as the perfect one. So I don't diversify. I don't think that Mintos requires diversification, because in the end, you are diversifying at the moment that you are investing in different loan originators through Mintos. So I don't think it's necessary to increase that level of diversification. Okay, more questions. Jesus Torn, when you were talking about average return rate, like in the case of real estate investment type, is the inflation rate taken into account when getting that percentage? You mean inflation, no? Right? Because it's you put inflection. I think it's inflation. No. It is not taken into account, because in fact, that's the reason a bond is covering you against inflation right now, because it is taking more or less a 3% average return, and currently the inflation is around 2% or something, so you are getting a plus 1%. So it is not taking inflation into account. More questions. Which book from all of them do you recommend to start with? Okay, good question. I really don't know. Maybe the order I stated on the presentation, but I really don't know. I really don't know. Thank you, Jesus. Maybe we can try to go for the second one. If we can post a poll in LinkedIn, if people like the masterclass and so on, and we can try to go for the second investing masterclass. So I'm really appreciate really pleased with for sharing with you guys my knowledge. It's 1:35. I think we are a little bit out of time. So maybe is someone that doesn't imply Jesus, Daniel, or Purismoon, if someone has an additional question, I can try to ask them, to answer them, sorry. And if not, we can just close the masterclass over here and have a nice Saturday, and hopefully we will do it. We will do this not soon. We'll do this soon. Okay. Thank you guys for your attendance and for your support during the meeting. Okay. Thank you, Daniel. Thank you. Okay, so we are gonna end the live over here. Thank you so much. Thank you so much. I would really appreciate it. I'll want to make something at the very end because I completely forgot, and it's just to thank our sponsors for being here, and for Acatech, which is a really strong company in the aerospace sector, doing mechanized material sensing, which is providing sensors. They are providing us some inertial measurement units for the prototype. Maxon, which is helping us with their motors for our prototype for ESA flyothesis, and RS components, which are gonna help us with their material in the prototype development. So thank you so much for this to everyone, and see you in the